Hi, this is Vijay Bambwani, and in this video, I'm going to talk to you about things that you should not do. We've spoken enough about what to do in the market, but believe me, as a good friend, a Samaritan, a guide, or call it whatever you want, the job of an advisor, friend, mentor, guide, whatever it is that you want to call me, is also to caution people about what not to do. You see, making profits is important, but not losing money is also important. And there are times I have to walk a very thin dividing line. You could call it the razor's edge on recording videos that aren't exactly either very pleasant news or sometimes rub people the wrong way, either because they misunderstand or because the advice is going against their belief systems. That basically results in comments which can be a little caustic. But hey, keep them coming. Everything, bouquets, brickbats, everything is acceptable. So the more you communicate with me, the better it is. I could get a feedback from you about what is likely to go down well or otherwise. But in this video, this is actually a follow-up video about the 3 videos that I have recorded in the Fast Profits Daily. The one on 29th of June 2020 about how not to get taken in by zero brokerage offers from brokers who are enticing you to open accounts with them. And then on 9th of September 2020 about the perils of trading in the dabba market or the unofficial trading market, where no bills, no paperwork or any kind of KYC or official give and take is done. Now this is an illegal parallel market. The third video that I had made, which is an extension, this video is an extension too, was on 12th of October 2020 about how Robinhood trading was redefining the way trades are taking place in the market. I had said that this was a brave new world and sort of something that old world traders like me don't really feel very comfortable about. And guess what? The Securities and Exchange Commission, the SEC, has initiated in-depth inquiry on Robinhood traders and fined it $65 million in penalties. Guess what? In spite of this 65 million penalty, Robinhood promoters are still going to go laughing all the way to the bank. And as per the principles of basic accounting and finance, every debit is matched by a credit and vice versa. So if Robinhood promoters are grinning all the way to the bank, there has to be some loser also who's lost a proportionate, if not a disproportionate amount of money. No prizes for guessing. It's the clients, the subscribers of Robinhood who've lost money. Is there a lesson in this for us in the Indian context, or why even the Indian context, the global context? Yes, there is. I'm going to explain this to you in this video because frankly, I get extremely disappointed when I interact with traders or people contact me on social media, which I love hearing from people, of course. Provided you're open to the idea of modifying your trading system, if you ask a question and get an answer from somebody who's better knowledgeable and you're willing to modify your way of trading, that's proactive. But if you're stubborn and you refuse to let go of your belief systems, believe me, you're wasting the time of the person you're raising a query to. And unless you're willing to change, why even raise that query? So unfortunately, when I ask people simple questions like, how do you select a counter to trade? Do you know what percentage terms mobility or intraday range that this counter offers? And have you tailor-made a trading system based on this intraday tap of this particular stock, commodity, currency, or index? People draw a blank. They just don't know what to answer. For example, when I ask people, do you know what is your execution cost per crore of turnover? I can bet a vast majority of people don't know an exact answer. At the same time, if these guys were to own a shop or a showroom or run a factory, they would calculate everything, the cost of raw material, labor, electricity, tea, coffee, expense, etc., transport per unit of goods sold. But when you are dealing in stocks, commodities, currencies or indices, derivatives, etc., why do you not do this kind of a calculation? At Equity Master, we actually compiled a list of things to do and not to do, and how much brokerage you should pay max to be able to avail of super fine trading services where a lot of trades, frequent trades, are likely to occur. Because it is important for you to keep your cost and execution costs like brokerage, GST, exchange turnover taxes, STT, stamp duty and SEBI turnover tax will eat into your profits. This Robinhood scam has actually eaten $34 million, if not more. $34 million is something that has been only found. The investigation is still underway, and there could be a lot more disclosures coming in as time follows on of the investigation. So I'm going to tell you how the modus operandi was. Robinhood did not believe in charging brokerage or commissions to its clients. Now that itself should tell you, hey, this is too good to be true. And anything that's too good to be true, as per oldies like me, I'm 55 years old. I've been trading in the market for 35 years now. I got a lot of gray hair to show for it. I am extremely circumspect and cautious about tall claims, especially, the kind that you get in your SMSs saying 110% return per month, 100% trading accuracy with XYZ software, only so much fee per month. These are all tall claims, too good to be true. So Robinhood was too good to be true also. Zero brokerage. So how did they make money? They basically gave you a two-way quote, a bid and an offer, a buy rate and a sell rate. Remember what I said in the Dabba trading video of 9th of September 2020. Your counterparty, the person you're buying and selling to, is the Dabba trader itself. So if you want to buy shares, there must be a seller. If you want to sell shares, there must be a buyer. In the Dabba market, since no transactions were going through the exchange, the Dabba operator himself was buying and selling to you. Guess what? He knows how to win. Therefore, you'll always lose. Now, Robinhood was basically making money by offering you a bid and offer spread. The difference between the buying and selling was its profit. But was it not executing these costs on the exchanges? Yes, they were. How did they go about it? They were going through other brokers who were channeling or funneling their orders into the exchange. Do other people also do it? Yes. E-Trade and Charles Schwab, the benchmarks in American online trading and broking community, also channelize their orders through external brokers. But Robinhood actually went to the extent of 70 to 75% of their total trade book size going through outside brokers. And they shared 80% of the bid and offer difference with the broker. What I mean is that Robinhood's share in the bid and offer spread, the difference between the buy and the sell rate, Robinhood took away 80%. The industry norm, for the want of a better word, the norm is that the broker through whom you're channeling your trade only gives you 20% kickback. Robinhood received 80%. Why? This is another question that comes to my mind. Why would a broker offer 80% of his bid and offer spread, which is a profit, to Robinhood? Because Robinhood allowed it to offer a very big difference between the bid and the offer. Who loses? The investor and the trader loses, because he gets such a wide difference between the buy and the sell that his profit is going to be very small, if at all. If at all. Secondly, Robinhood made money on the interest it earned by taking the deposits kept by their clients in loans. This interest was not shared with their clients. Wakey, wakey, there is no such thing as a free lunch in life. Thirdly, Robinhood enticed its investors, traders, clients, subscribers, call it what you want, to upgrade to higher ended services which were paid for. So the fees earned in those services and extra bells and whistles that they were giving were supposed to be the profit that Robinhood would take away. Included in the gold scheme, which is a paid scheme, were things like trading aftermarket hours. That itself should raise a red flag for you. Trading aftermarket hours. Remember 9th of September 2020 video, Dabba trading. Got it? Then they would also offer their clients shares on loan so that they could short sell the shares, deliver them to the exchange, buy it back at lower prices and give it back to Robinhood. What would Robinhood earn? It would earn a rent or a fee for loaning these shares. Now, all these have come out in the Securities and Exchange Commission's inquiry into Robinhood. How do you get impacted in the Indian context? Do you know that brokers pay something called an exchange transaction tax? If you take your brokerage, your contract note of the day, you will see that you are paying 6 kinds of charges. First is brokerage, second is GST on that brokerage, the third is STT or Securities Transaction Tax, turnover tax or commodities transaction tax, depending on which exchange it is on. Then you pay exchange turnover charges, then you pay stamp duty, which varies from state to state, and then SEBI transaction charges. Now this exchange turnover tax is not a fixed fee. It's a telescopic charge. So the higher is the turnover of a broker, the lower is the slab of the tax paid by the broker. Which is why brokers want more and more turnover generating clients so that they pay a smaller percentage of the exchange turnover tax. Now when a broker routes a transaction, a small broker who's unable to pass through the 100 crore turnover per day club and therefore knows that he will have to pay a higher turnover tax, when he routes his order through a broker who is 1,000 crore per day turnover guy, he has to pay a small exchange turnover fee. But he can charge the routine exchange turnover fee to a client and pocket the difference. Now this is something why there is a brokerage rate war going on. The bigger brokers can actually offer you cutthroat discounts because they are saving money elsewhere. So if you are getting offers from smaller brokers who are telling you we'll charge you zero brokerage and no other charges, etc., except for the actuals that you pay in terms of GST, in terms of STT, stamp duty, SEBI fees, exchange turnover tax, etc., remember that things may be a little different as compared to what you are being told they are. It is only the vigilant trader who makes money in this market. The dice is actually tilted against you. No more than 8 to 12%. Now the percentage varies on a day-on-day basis. No more than 8 to 12% of traders consistently make money. The remaining come there, make money on a fluke, lose money most of the times over a period of time, lose their capital and go away. I can bet that this minority of 8 to 12% traders know their onions from their beetroots. They know how much they are paying, they know how much is the brokerage, the exchange turnover tax, the STT, the SEBI stamp duty, etc. They have a strict control over their costing and therefore they are the super sharp traders. I want my viewers on the Fast Profits Daily video to be in this super sharp category and I will keep bringing you videos that will help you become super sharp traders. On this promise, I'll say goodbye to you in this video, not before assuring you there are more videos to come on this in the future. If you're watching this video on YouTube, please click like on this video. Subscribe to my YouTube channel if you haven't already done so and click on the bell icon so you receive alerts of new videos being put up in this YouTube channel. In the comments section, I'd love to hear from you about what you think of this video and what you'd want me to record in my next. Help me reach out to fellow like-minded traders and investors who believe in knowledge-based investments and trading systems by referring this video to your family and friends. Do take very good care of your health, your family, your trades and investments. Have a very, very profitable day ahead. Vijay Bambani signing off for now. Thank you for watching. Bye-bye. Also, do not forget to subscribe to my free email newsletter, Fast Profits Daily, and get my free guide, How to Trade Markets Like a Pro.